So today we're doing Chapter 10, and Chapter 10 tends to cause some problems on the final exam. So I want to be absolutely certain that you understand this. Chapter 10 is incredibly important with regards to moving forward with intermediate financial accounting. It's a direct tie-in to an intermediate chapter on liabilities, and also it ties into the calculation of bonds for investment purposes. It also ties into notes receivable and notes payable. So I want you to understand the whole issue of present value, and that's what we're going to cover off today. The new content, which is installment notes payable, how they work, and the two different types. So we can look at our first question in this package, and that's question 10-1. So we've got Blue Corporation, and they issue a 5-year 4% $100,000 mortgage payable on December 31st, 2016. The terms provide for semi-annual installment payments on June 30th and December 31st. Now, we do realize that with a normal mortgage payable, you would be paying every single month. But the problem with that is I'm going to do 12 payments then for 5 years, and that just doesn't make sense. I mean, the amount of work that would involve for you and I to do. So I'm using semi-annual as a demonstration, but be aware that under normal circumstances, a mortgage payable is paid on a monthly basis. So hopefully that's, going to work for you. What we're really looking for installment notes payable is the fact that these notes are long-term. They're greater than 1 year, and therefore they're considered debt financing. So I want you to know how to deal with long-term liabilities. And in this case, that's what we're talking about, the note payable. So we want to, number one, so this is Q 10-1 in part 1. We want to record the issue of the mortgage payable on December 31st, 2016. And it's a $100,000 mortgage payable. So the question is, what did we get? And we would have received cash for $100,000. And then what did we give away? We gave away a note payable. And a note payable is very different than an accounts payable. A note payable is long-term, and long-term liabilities have a number of factors. One of them is they have a maturity date. So we can see that this is due in 5 years. The $100,000 has to be paid back. Well, by the end of the 5 years, $100,000 will be paid back. So it's got a maturity date. It's got an interest rate. And it is actually a binding contract between two entities. One that is external to the corporation. So be aware that's the difference. If you're looking at an accounts payable, it's an implicit contract between two individuals. It has no maturity date, and there is no explicit interest rate. You might pay overdue cost or interest charges for not paying your accounts payable on time, but it's not an explicit interest rate that is an agreement between two parties, as it is with a note payable. So this is a binding legal contract. So what did we get? We got a note payable. Sorry, what did we give away? We gave away a note payable to the bank for $100,000. So that's our first entry at the issue of the note payable on December 31st. My apologies, December 31st, 2016. All right, so now we need to record the first two installment payments on June 30th, 2017 and December 31st, 2017, assuming the payment is a fixed principal payment of $2,500. So I'm just going to go to a new page because I don't have enough room here. So in this case, the easiest thing to do is to create a chart. So we've got a chart here, and we've got the interest period, which is just the date. Then we've got the amount of cash. We've got amount of interest expense. We've got the principal. What's going to happen to the principal? And then we've got the principal balance moving forward. All right. So when we're looking at this, we are going to have a fixed principal payment of $2,500. So when you think about this, the principal is always going to go down by $2,500. At the beginning, when we take this out on December 31st, 2016, this has nothing, this has nothing, this has nothing, but the principal payment right now is $100,000. So now we move down to June 30th. 2017. And at that time, we know that this is a fixed principal payment. So every single time, the amount of the principal will go down by $2,500. The question is, what are we going to have to pay in interest? Because we want to know what the total charge will be for the interest. And you've got to think that from December 31st, 2016 to June 30th, 2017, a full $100,000 has been outstanding, and we've had the use of that $100,000. When you think about that, that is $100,000 times 4%, and we know 4% is an annual rate. So we've got to multiply it times the 6/12, which is the number of months that it's been outstanding. So that amount is actually $2,000. So now, how much cash will we have to hand over to the bank at June 30th, 2017? And the answer is, we have to hand back the $4,500. What will be the impact on the principal balance after the payment is made? Well, the principal balance is going to be this $100,000 minus the $2,500 that's going to go down. So it's actually going to be at $97,500. So what is the entry that we would do at June 30th? So let's just flip back one page. So now we've got June 30th, 2017. We know what's going to happen. We're going to have a credit to cash for the amount of cash we pay. And the chart tells us how much we pay. We pay $4,500. But we're also going to have a reduction in our note payable because our note payable is no longer $100,000. Instead, the note payable is going to go down by the $2,500. And then we have to recognize that we also have to pay interest on the amount that was outstanding for the period of 6 months, and that's going to be a debit to the interest expense for the $2,000 that we calculated. Any questions about this, or are we good to move on? Thumbs up, some kind of indicator? All right. Thank you. All right, so let's go back to our chart. We're going to continue on with this, but now we're going to do December 31st, 2017. Again, you'll notice that the principal impact is going to be the same. The principal impact is always going to be $2,500. And if we could continue this chart down, we would simply write for every single 6 months, $2,500. The principal effect is never going to change because we've got a fixed principal payment, a fixed principal payment of $2,500. However, the interest expense is now going to change because instead of having $100,000 outstanding, we now only have $97,500 outstanding times the 4% times the 6/12. So what does that equal? That equals $19,500. That's our interest portion. If we add together the $19,500 and the $2,500, or sorry, I just said $19,500. If we add together the $1,950 and the $2,500, we're going to get the amount that has to be actually forked over to the bank, and that will be $4,450. So let's do the entry at December 31st. Oh, I forgot to put down the balance, the principal balance. We're going to subtract the $2,500 that we've just paid, and that will give us our new balance, $95,000 moving forward. If we now go back here and we do the entry at December 31st, we're going to see right away that at December 31st, 2017, we're going to hand over cash to the bank. And the cash amount will be the $4,450. We're also going to recognize that the note payable is no longer as high as it was before because we've paid off a portion of the principal, $2,500. In addition, we're going to recognize that we have an interest expense for the use of the money for the 6 months, and that interest expense is $1,950. Are there any questions at all about the fixed principal payment and how we can build a chart. Wait, I'm going to flip back to the chart. And how we can build a chart to recognize this. Any questions about this or the entries? Or are we good to move forward? All right, thank you so much. Okay, so this is one way of paying down your mortgage, but we could also have a blended principal and interest payment. So in a blended principal and interest payment, we always pay the exact same amount every single month. So this is far more common than, well, not really. There's various choices now. It used to be far more common to have a blended principal and interest payment, but there's many choices available now which would have just a flat amount for the principal effect, such as $2,500. But many mortgages still exist with the blended. So how do we recognize the blended? So let's start with what would be the entry when we record the issue of the mortgage payable. And actually, we're going to flip back for a moment. The entry would actually be identical. So this entry at December 31st would have no change to it. We would still recognize the exact same entry. So this is both true under the blended principal and interest payments as well as the fixed principal payment. So there's no difference to the entry at December 31st, 2016. So as long as we understand that, we're going to move forward with the chart. So now I'm going to do a chart that uses the blended principal and interest payment of $3,622. Sorry, I've just got to flip my page. There we go. All right. So now, again, we've got the interest period. We've got the cash. We've got the interest expense. We've got the principal effect. And we've got the principal balance. We're going to start, of course, with the exact time that we take out the loan, December 31st, 2016. There's nothing in any of these, but we have a principal balance of $100,000. So now let's fast forward to June 30th, 2017. We're going to have a cash payment of $3,622. It doesn't make any difference what's happened during the period. This is the amount that we will pay every 6 months. And so you have to see how similar this is to paying your mortgage every single month, right? It's a fixed amount and you're going to pay that amount. There's no discussion about it. The question becomes, what is our interest expense for that portion? And so for the interest expense, we're going to do the same thing we did before. $100,000 times the 4% times the 6 over 12. And it's still going to be equal to the same amount, $2,000. We're going to take the $3,622 and we're going to subtract the $2,000, and that will tell us how much the decline in the principal is going to be. And the decline in the principal is going to be $1,622. Therefore, if I take this away, minus $1,622, it tells me how much the principal is remaining after this, and that's $98,378. We're now going to make an entry for this. So, of course, what's my entry going to be? Well, I'm going to recognize, at June 30th, 2017, I'm going to recognize the amount of cash that I have to give to the bank. And the amount of cash I have to give them is always going to be the same, $3,622. However, the amount that's going to reduce my note payable is only going to be $1,622. What I also have to do is I have to do a debit to the interest expense. and that debit to the interest expense will be for the $2,000. So notice again that if I was looking at my T account for the note payable, I would have started with the $100,000. I would have taken away the $1,622, and the balance would have been the $98,378, which is exactly what will show up on my statement of financial position. So now let's go back to the chart. Here we are, and remember, this is for blended. So now I'm at December 31st, 2017. Again, the cash amount is going to be $3,622. Contrast that to the fixed principal payment that we have right here. When we had the fixed principal payment, the principal effect was always the same, but the cash amount was continually changing. When we have the blended payments, it's the exact opposite. So the cash amount stays the same every single time. But my principal effect is going to change. What's going to happen this time for my interest expense? It's going to be $98,378 multiplied times 4% multiplied times 6/12. That is going to be equal to $1,967.56. So if I take the $3,622, I subtract the amount of the interest expense, that's going to get me my principal effect. And my principal effect here will be $1,654.44. If I take away that $1,654.44 from here, our principal will remain at $96,723.56. Again, you'll notice that the principal effect is changing. In fact, as time goes on, our interest portion of the $3,622 will continue to decline, and our principal portion will continue to increase. Why is that? Because the principal balance is continually declining, and therefore we're paying less and less interest out of the $3,622 payment. What would our entry look like at this point? Well, our entry at December 31st, 2017 will again be a credit to cash, and you'll notice that the credit to cash is still at $3,622. It'll be a debit to the note payable for the interest effect. Sorry, I just said interest effect. It'll be a debit to the note payable for the principal effect, which in this case is $1,654.44, and it's going to be a debit to the interest expense because we have the use of the money over time, and that's $1,967.56. All right. Is there any questions at all about these two methods? Or are we good to move on? Thank you, Jing Jing. Joanna? Jessica? Excellent. Okay. So now, the last question, question number 3, says, explain why interest expense is the same regardless of whether the payment is blended or based on fixed principal payments for the 6 months ending June 30th, but different for the 6 months ending December 30th. Well, actually, it'll be different for every single month thereafter, or every single semi-annual thereafter. In this case, the interest expense is $2,000 because if we look at our calculation, we actually had $100,000 outstanding. Well, if we look at the calculation from the fixed principal payments, we had $100,000 outstanding also. But in this case, the principal is going down by $2,500. So this amount in December 31st, 2017 is a different amount than the amount we have here at December 31st. 2017. Why? Because the principal effect is different. And that's why. So the interest expense changes between the two methods because the amount of the principal is declining at a different rate. All right. So let's move on to the most challenging part of Chapter 10, and that is bonds. So I've got two questions for bonds. Oops, sorry. Let me change that color back. That's question 10-2. Now, bonds are a form of debt financing. Companies, the bond market is very, very active, and companies issue bonds so that they'll be able to raise funds for things like investing activities, which you covered in Chapter 1. Investing activities is the purchase of long-lived assets, such as property, plant, and equipment, and intangibles, such as a patent or a copyright. So companies issue this type of debt. And this debt is very unlike share issue. When we were selling shares, that was owner's capital, and owner's capital does not require servicing. Companies can pay dividends, but it's a choice to pay dividends. They have to declare dividends. Whereas when we issue debt as a corporation, we have to service the debt by paying interest. So one of the most important things about bonds is the fact that when bonds are issued over the long term, it may be that the bond rate is not the same, and I'm talking about the coupon rate, is not the same as the market rate, and we have to take that into account. So how do we take that into account? We're going to walk through this question slowly, so I'm hoping you get a very clear understanding how to do this. All right, so Green Corporation, I'm just going to write down the information here so we have it in front of us. Green Corporation, on January 1st, 2016, they issue a bond. So when they say they issue a bond, they're selling bonds to the open market. And the bond actually isn't worth $250,000. There might be a whole bunch of bonds for $1,000 each, and individuals are purchasing those bonds on the open market. So on this date, they sell a total of $250,000 worth of bonds. This is called the face amount. And the face amount is what the individual who purchases the bond will expect to receive at the end of the bond's life. So how long is this bond's life? This bond will last for 4 years. And bonds are various lengths. I've chosen 4 years as a short period of time so I can show you the full 4 years. If I did a 10-year bond, we'd be here forever. So I'm just choosing a shorter period of time so I can show you the whole process. So in 4 years' time, the individuals who purchase this bond will get the $250,000, the face amount, back. It is a 4% bond. This is called the coupon rate. And the coupon rate is the amount of interest that the individuals who gave up their money are going to receive over the life of the bond. Now, this is the coupon rate. But sometimes the coupon, and it happens quite a bit, the coupon rate is not the same as the rate that's available in the market for a similar investment vehicle with the same level of risk. You have to think that the level of risk changes the interest that has to be paid. And let me give you an example. If you purchase a Canada Savings Bond, how much do you think the interest rate will be on a Canada Savings Bond? Canada, by the way, is considered a very safe country with regards to our economy. So when the government issues a Canada Savings Bond, which is exactly what we're talking about, a bond, this is a corporate bond, but Canada Savings Bonds are exactly the same. When they issue a Canada Savings Bond, what do you think right now the interest rate would be? Just give me a guess. Or Google it. Oh, 0.5%. 0.8%. It depends on the length of time that the bond is going to be held by the government, right? How long are they going to have your money? And the longer the period of time is, the higher the interest rate will be. And that's because over time we feel that interest rates are going to continue to increase. But you'll notice how low the interest rate is. They're pretty low, right? I mean, they're not a lot of money. And that's because the borrowing rate right now for money is very, very cheap. And it's also because of the riskiness of Canada Savings Bond. Canada Savings Bonds are considered extremely safe. There is no belief that the government will be unable to pay the bond when it becomes due. However, if you went over to Greece, how much do you think Greece's equivalent, saving bonds, government saving bonds, would be paying right now in interest? Yeah, it's not that high. It's about 10%. It's been ranging between 8% and 12% for quite some time. But that's a government. Why is their interest rate on their bonds so much higher than the interest rate on our bonds? Starts with the word R, guys. Risk. That's exactly what it means. The level of risk indicates the interest rate. As risk increases, the interest rate is going to go up. So corporate bonds actually are rated. And you might get a corporate bonds that are rated AAA, but there's also bonds that are BBB, and there's various iterations in between. So an AAA bond might only give you 0.75. I haven't looked recently, so I can't tell you percent. But a BBB bond will give you 1.80%. So what is the factor that differs between this one? And the answer is risk. This corporate bond is from a very large blue chip company, and so the interest rate is going to be very, very low, because the likelihood of you not being paid the $250,000 at the end of the life of the bond is almost nil. So you're talking about bonds from like Johnson & Johnson and McDonald's Corporation. The likelihood of them going bankrupt or not paying back the bond is low. But as the rating on the bond goes down, the risk level goes up, and as a consequence, the interest rate goes up because of the level of risk. So sometimes corporations set their interest rate on the face of their bond at 4%, but there might be a change in the interest rate over time. And when there's a change in the interest rate over time, the actual market rate for another investment vehicle at the same level of risk will be different than the coupon rate that is being paid on this face amount. So let's assume that the market rate for another investment vehicle at the same level of risk is only 2%. So this is the market rate. So you got to think, you go out into the market and you want to purchase an investment vehicle. You can purchase an investment vehicle at 2%, and it's fairly safe. But you can also purchase this bond at 4%. Which one would you prefer? And don't forget, they have the same level of risk. Which one would you prefer? The investment vehicle at 2 or in the investment vehicle at 4? The one at 4%, exactly. Now, everybody's going to want the one at 4%. So what do you think is going to happen to the price of the bond? Exactly. It's going to be bid up. The price of the bond is actually going to be bid up until the two investment vehicles are equivalent. And that means it's going to be bid up until the yield on this bond is equal to 2%. So yield is different than the coupon rate and the market rate. The yield is what you'll actually get after you bid up or down the price. Because you got to think that you might bid the price down if this was reversed and your bond was offering 2% and the market rate was 4%. You wouldn't be willing to pay $250,000 for that bond because you could get an other investment vehicle at 4%. So if this was flipped, and if 4% was the market rate and 2% was the coupon rate, now you wouldn't want to pay $250,000 for the bond because you could get a better investment vehicle at the same level of risk in the open market. So now, what we have to figure out is the investors who know that this bond is going to give 4% when the market rate is only 2%. So we're going to go back to the actual question. The investors are going to bid it up until the yield is equal to 2%. As soon as the yield is equal to 2%, they're going to stop bidding up the price. So we can actually calculate in an efficient market exactly what price this bond would sell at. And the amount that it would sell at is the present value. And that's what we're going to do right now. We're going to calculate the present value. We're going to use the market rate to calculate the present value because when we do that, that present value will end up giving us a yield of 2%, which will be equal to the market rate. All right. Let's calculate the bond's present value on January 1st, 2016. When we're calculating present value, and remember, present value is the amount that you would be willing to buy the bond for to get an equivalent market rate of 2%, a yield of 2%. So we have to do two present values. We have to do a present value of the principal amount. The principal is $250,000. We want to calculate the present value. So in 4 years' time, we're going to get $250,000. But you know that $250,000 in 4 years' time, will it buy you the same things in 4 years' time that you can buy right now? Nope. Exactly. Money in the future is worth less than money right now. Why is money in the future worth less than money right now? Exactly. Inflation. Two things, actually. It's inflation and opportunity cost. But let's just focus on inflation. If inflation goes up, well, then we know that in the future, when we get to $250,000, we won't be able to buy the same thing. A perfect example of that is this house that I'm in my house, right? I'm upstairs in my teaching room. And when we bought this house in 1993, which totally shows my age, when we bought this house in 1993, it cost us $205,000. And we've done pretty well nothing on this house. We put $40,000 into the kitchen, and we've never done anything else in the whole house. We renewed the bathrooms, but we did that very inexpensively. And so this house is pretty well the same as it was in 1993. But right now, I could sell this house for $1 million. We've done nothing to the outside. We've replaced the shingles once when we moved in. We've really done nothing to this house. How is it possible that this house is now worth $1 million when back then it was worth so much less? And the answer is inflation. It has nothing to do with the intrinsic value of this home. It has to do with the fact that prices in homes has continued to rise over time, and that is due 100% to inflation. So the $250,000 that you get in 4 years' time are not going to buy the same things that you could get right now. So we have to calculate, if I wanted to buy the same basket of goods today that I can buy with $250,000 in 4 years' time, how much money would I need today? And I'm going to need less money. So we're going to use the present value tables to do this calculation. There are two present value tables. This is the present value of $1 in the future. So this is the present value of one payment in the future, and that's what we need. When we look at the number of periods, the number of periods is not equal to the number of years. It's equal to the number of interest payments over the life of the bond. So for instance, this bond pays interest, is it once a year or twice a year? The bond pays interest annually at December 31st. So in this case, this will be 4. But if I had a bond that was paying interest semi-annually, there would be 2 payments every year times 4. And in that case, I would have to look at 8. All right? So the number of periods is the number of interest payments you get over the life of the bond. Now, we also have the interest rate, which is I, right here. The interest rate is the market rate. So I'm going to write that here, market. Please don't ever use, ever, the actual coupon rate. You want to use the market rate because we're trying to figure out if we got an investment at the market rate, what would its value be right now? Because I want the yields to be calculated the same as 2%. So I'm going to use 2%. I go down on the 2% until I get to the 4. So my factor to calculate the present value of that $250,000 is going to be 0.92385. So you want to write down that 0.92385. We're going to go back to our page. So I'm going to take the principal amount and I'm going to multiply it times my factor. So I take the principal and I multiply it times the factor. And that is 0.92385. I'm going to multiply that times 250. And that is equal to $230,962.50. So if I received $250,000 in 4 years' time, it would be I could buy the equivalent package of goods as I could buy today at $230,962.50. Is everybody clear about that? Thumbs up if you are. All right. I also am going to get a different stream of cash. I'm going to get the interest payments. So I need the present value of all my interest cash flows. See, this is my principal cash flow that I'm going to get in 4 years' time, but I'm going to get some interest payments too. What are the interest payments? Well, they're going to be $250,000 times the coupon rate, right? Because the coupon rate is the amount of interest I'm going to receive, which is 4%. So $250,000 times 4% is actually going to be $10,000. I'm going to get $10,000 4 times over the next 4 years. It's going to be divided, or sorry, it's going to be at the end of every single year. So I want the present value of these 4 payments. Now, a lot of students will then multiply this times 4, but we don't do that. The factor will do it for us. So we're going to go here. This was the present value table for $1 in 4 years' time. I'm now going to use the present value for an annuity. An annuity is a series of payments of $1 over time. What is my periods? My periods, of course, are going to be 4. What is my interest rate? My interest rate is going to be 2%, the market rate. So I go over here, and there it is. There's the factor. Notice the factor is already taking into account the fact that I am going to receive more than one payment. So that's 3.80773. So we need that number. So I'm going to take this, I'm going to multiply it times 3.80773. Multiply that times 10,000. And that is going to be equal to 38,077.30. If I add these two amounts together, so the $230,962.50 plus the $38,077.30, that is equal to $269,039.80. So what do you notice about the present value compared to the face, which is $250,000? Does it make sense that the present value is higher? If so, why? I wait for your answer. Market rate is lower than coupon rate. Absolutely. So we're bidding up the price of this bond. Because the interest is higher than the market rate, the present value is higher than what you could buy in 4 years' time. Does everybody understand that? Thumbs up if you're clear on this. Ah, Joanna, I see you're confused. Okay, so let me explain it a little bit differently, just so we get some clarity. I'm going to go to the last page, and I'm just going to do a new page. Okay. So now, I'm going to do a timeline. And this is 2017, January 1st. And this is 2021. If I get 240,000, I'm going to use a different number. If I get 240,000 in this many years' time, all right, this is the basket of goods it'll buy me. Okay, there's my basket of goods. But if I have 240,000 today, notice the basket of goods that it will buy me, is a lot bigger. Do we understand that, Joanna? Thumbs up if you do. Or confused. Okay, good. All right, now, because this 240,000 is going to earn 4%, right? The value of this 240,000 when I move into the future It's not going to be $240,000. It will be more. It'll be like $255,000. Do you understand why that's the case? No. Because of the interest rate that's being paid. The inflation rate is only 2%. Exactly. So now imagine that your bond is making 4%, and in 5 years' time, you're going to have $250,000. It's making 2% more than the market. So when I present value this, it's not going to be $250,000. It's going to be more than $250,000 because I'm earning 4%. The $250,000 is taking into account only the 2%. I'm earning 4, so this amount here will be $255,000. If I use it the other way. Is that clear? That's what the present value is showing us. That present value, just a second, I need to go back to our page. This present value shows us that the interest we are receiving is giving us a bigger bang for our buck because it's greater than the market rate. So it's not just making up for inflation at 2%, it's giving us an additional 2%. And that's why the present value is actually higher than the $250,000 face value that you're going to get. All right. So now that we have the present value, you've got to see that this is the amount that investors would bid it up to. No one would bid it up higher than this, because if you bid it up higher than this, you'd be getting less than 2%, and no one's a fool as an investor. They just wouldn't do that. So this is the maximum amount that you will be able to sell your bond for, and you can bet in an efficient market that's exactly what it would be bid up to. So we've got to recognize that we are selling this bond at $269,039.80. So let's record the sale. So on January 1st, 2016, we would record the sale of these bonds. What would we get? Well, we'd get cash from all those investors who bought our bond. And that cash, sorry, I've lost the amount in my head. That cash amount would be $269,039.8. That's how much money the investors would pay us, right? Because they're all going to bid up the bond until the yield is equal to 2%. And then they don't care which bond they buy. They're indifferent between the other bond at 2% and our bond. Even though our bond is paying 4%, they're not going to get 4%. They're going to get cash of 4%, but they're not going to get a yield of 4%. Then they're going to credit, of course, the bond payable. $269,039.80. Okay, so now if we looked at the T account, we would have the bond payable, and the bond payable would be $269,039.80. Now, in 4 years' time, when the bond matures, how much money are we going to give the investors? Yes, we're going to give them the face value only. So really, when you think about it, the investors paid an additional, if you're really thinking about it, because they're only going to get back $250,000, the investors paid an additional $19,039.80 for this bond. Why were they willing to pay more for this bond? Because they bid up the bond price until the yield that they receive was only 2%. So they actually gave additional money to get back less money in the future. Why were they willing to do that? Because it's an efficient market and we're all going to bid up the price until the yield becomes equivalent. All right. So now, over time, we have to recognize that this $19,039.80 has got to be drawn down. So we have to have negatives against this over the next 4 years until the face value of the bond is represented in the bond payable account. How do we do that? and it's called the efficient interest rate method. All right, so I'm going to show you the chart that we would use for the efficient interest rate method. Let's do the chart. Okay, and this is number 2 on the page. So in this chart, we would have a date. We would have the amount of cash that we're going to fork over to the investors. We would have the interest, that implicit interest that we are paying, the difference, and then we're going to have the present value of the bond. So at January 1st, 2016, we've got none of these things yet, but we do have a present value of the bond. Remember, the present value of the bond is $269,039.80. Now, at the end of every year, we're going to pay interest. And so at December 31st, 2016, how much cash are we going to fork over to the investors? I'm going to ask you guys. How much cash are we going to fork over? How much interest do we pay on these bonds? $10,000 exactly. Cash is always the face value times the coupon rate. It's not like we've agreed to pay them extra. We're just going to pay the amount that we've always guaranteed that we would pay, the $250,000, which is the face value, times the 4% interest, which is the coupon rate, and that is going to be equal to the $10,000. Okay, that's never going to change. That's all we're giving them. When they gave us extra money, that doesn't make any difference on the amount we're going to pay. We're only going to pay the 4% we promised them. But the interest that they're actually earning is going to be less. Can someone tell me why the interest they will actually earn on this bond is going to be less? Think about what they paid for the bond and tie that in to the interest they're earning. Are they going to earn more than $10,000 or less than $10,000? I'm just letting you guys think about it. What are your thoughts? The present value is higher. It absolutely is. The amount they paid is higher. Let's go back to the amount they paid for a moment. They paid $19,039 more for the bond than its face value. They're actually earning less than $10,000 because we, in effect, when we pay them that $10,000, a portion of that $10,000 is the extra amount they gave us. They gave us more money, and when we pay them back the when we give them the $10,000, we are in effect giving them back some of their own money, not our money, their own money, because they were willing to pay more for this $250,000 bond, right? And they were willing to pay more because the interest rate was higher. So when we look at this, even though we pay them $10,000, we don't have to fund 100% of that $10,000. A portion of that $10,000 is actually being funded by the bondholder's own money. Thumbs up if you understand why I'm saying that. I don't see any thumbs up. This is very concerning to me. Confused. The money that they're going to get in 4 years' time is $250,000. They're not going to receive anything except for the $250,000, plus they're going to receive 4 times $10,000. That's what they're going to get. All right? So over the life of the bond, in absolute dollars, right, they're going to get $290,000. Does everybody agree with that? Does everybody agree that the cash they're going to get in their hand is $290,000? 4 times 10,000 and the 250 at the end of the 4 years. But they gave us $269,039.80 to get that amount. So in effect, they're not getting $290,000 anymore because they were willing to pay $269,039.8 for it. So in effect, they're actually only getting, when you think about it, they should have gotten $40,000, right? $40,000 of interest. Are they going to get $40,000 of interest? No, they're only going to, wait, I got to do the math, 290,123 minus 269,039.8 equals, oh my God, they're only getting $20,960.20. Does everybody understand that? Okay, so they actually are funding some of the interest payments by paying extra. The yield that they're going to get on the bond is only 2%. They may feel like they're getting 4% because they still get in their hand $10,000. A part of that $10,000 they paid for themselves. So if we go back to here, we've got to calculate what is the true interest expense to us, because even though we fork over $10,000, because they paid us extra, they have funded part of that $10,000. So how much interest are we actually paying? Well, we're paying the present value times the market rate. Even though we're paying, now, be honest, we're forking over $10,000, but don't forget, that $10,000 doesn't all come out of our pocket. A portion is coming out of the money that those bond investors gave to us at the beginning. So if I do this present value, 269,039.80 times the 2%, that's going to tell me the actual interest expense to me. So that's 269,039.8 times 0.02, and it's equal to 5380.80. I'm going to round it, right? It's actually 0.796, but we always round to 2 decimal places. So notice, even though we're paying them $10,000, our actual interest expense is only $5,380.80. So now, where does the difference go? Well, remember, at the beginning of this process, I said to you that there has to be 4 amounts placed against this bond so that by the end of its life, it's only worth $250,000, which is what we're going to pay them at the end of the 4 years. This is the difference. So the 10,000 minus the 5380.8 is equal to $4,619.20. This is the amount that the investors have funded out for the interest. This is that portion, I'm going to go back here, this is that portion of this $19,039.80. That's the portion. And we're going to put that portion right here, and it's going to draw down the bond payable until it's worth $250,000. So now I'm going to take this, I'm going to subtract this, and it's going to give me the amount 269,039.8 is equal to $264,420.60. So the present value of the bond is going down because the investors paid some of the interest themselves when they bought the bond for more. Thumbs up if this is clear. Thank you, Joanna. Jing Jing. Everybody else okay? Suhara, Jessica, okay. As long as everybody's clear on what's going on here. Now I have to make an entry at December 31st, 2016 because I'm forking over $10,000, right? So I have to recognize the amount, not only that I'm forking over, the $10,000, but I also have to recognize that the interest expense is only going to be $5,380.80, and that the bond value is going to go down by $4,619.20. So let's just do that entry for a moment. I'm going to need a new page. Okay, so this is at December 31st, 2016. I'm going to recognize that I'm going to fork over cash of $10,000. I'm also going to recognize my interest expense at the lower amount because, of course, I didn't fund 100% of the interest. Some came from the investors paying more, $5,380.80. And I'm also going to recognize that the notes payable, oh, sorry, I just said note payable. The bonds payable is going to go down by $4,619.20. So if I go back up here, that first amount here will be $4,619.20. I'm going to start drawing the bond payable down. Going back to my chart, here we go. We're going to do the entry now for December 31st, 2017. How much cash am I going to pay on December 31st, 2017? Exactly, $10,000. What is going to be my implicit interest? I want the amount. 528841. You got it. Which is the $264,420.60 times 2% interest. Rounded is equal to 5288.41. If I then take that amount and I subtract the 10,000 from it, it's going to tell me how much the present value is going to decrease by, which is, oops, wait one second. No. I have $4,711.59. Oh, just one second. Is that correct? Okay, good. Thank you, Jessica. So now I'm going to take this amount, I'm going to subtract it from the present value, and that will give me my new present value, 264420.6 is equal to, so I've got 259,709.01. Does everybody understand that? Okay, so now going to my entries again, I'm going to do an entry at December 31st, 2017. I'm again going to have a credit to cash for the $10,000. But this time I'm going to have a debit to the interest expense. And sorry, I can't remember what the amount is. Wait one second. Oh, yeah, that's what it is. Okay. So that is 5288.41, and I'm going to have a debit to the bonds payable for the difference, which we figured out was, and I've already lost it, 123 minus 5288.41 is equal to 4711.59. Now, if we look at our T account again, what's going to go over here? 4711.59. We're drawing it down to the $250,000. Okay, so now December 31st, 2018. What's going to happen? We're going to pay the $10,000. What else is the implicit interest? The implicit interest is going to be 259,709.01 times the 4%. Oops, I just said 4%. Oh, terrible. Times the 2%. What is that equal to? Wait one second. 259,709.01 times 0.02 is equal to 5194.18. Does everybody agree with that? Excellent. Then the amount of the present value is going to go down by 4805.82. And if I take that and subtract it from the present value, that is going to be equal to 259,709.01 equals 254,903.82. 0.19. What are we then going to do then? Well, we're going to do the same, and I'm not going to do it again, guys. Is it okay if I don't do it again? You know what the entry is going to look like. It looks exactly the same every single time. Okay, good. So, of course, that's going to put, just one second, over here, when we're looking at the 4805.82, that's going to actually go against our bond. So we're going to put 4805.82. All right, so now we're in the last year. What's going to happen at December 31st, 2019? We're still going to pay the $10,000. But this time, because we're at the end of the year, we have to have this equal to $250,000. So instead of multiplying the present value times 2%, we're actually going to work backwards just to make it work. There's always going to be a slight rounding error. So if you use the percentage, you're never going to end up with $250,000. So instead, we work backwards. We know this has to be 4903.19. And if we take the 10,000 and we subtract the 4903.19, it's going to be equal to 5096.81. So what is our entry at December 31st, 2019? Because we're not just paying them the $10,000, right? Don't forget, I'm missing December 31st, 2018. Please be aware of that. I didn't put it down, but I'm moving on to December 31st, 2019. What am I going to do? I'm going to do a credit to cash of the $10,000. I'm going to do a debit to the interest expense of 5096.81. And I'm going to do a debit to the bond payable of 4903. Just one second. I want to double check that I've got my numbers right. 4903.19. If we do that, 4903.19, this is now going to be equal to $250,000. And guess what we're going to do at December 31st? The entry had to be for the bond payable $250 and the credit to cash for $250,000. And when we make that entry, if we go back here, you got to think that we're making an entry for $250,000 against here, and the ending balance at this point will be equal to 0 because we paid back the investors 100%. Keep in mind that when we ended up paying that, even though it appears like we paid $40,000 over the 4 years, we actually only paid $20,960.20 because the investors paid an additional $19,039.80 in addition to the $250,000 face value. Is everybody good to go? Excellent. We can move on to the next question. Yes. Let's move on to the next question. Okay. So we're now at question 10-3. In 10-3, you'll see that this is a slightly different scenario. Orange Corporation on January 1st, 2016 issued a $150,000 bond, 4 years, at 2%. Financial statement. Sorry, what do you mean? What did I miss? What did I miss? Does it say something that I missed? Show the statement of financial position in December 20. Oh my goodness. I'm sorry. That's totally my fault. Let's go back to the chart. Nope. That was my panic. Please wait. Yes. At December 31st, 2016, what would it look like? So let's go back as if we didn't do everything that we did, because I should have done this beforehand. So here we are, we're right here, right now. What would it look like on the statement of financial position? Well, on the statement of financial position at this time, our bond would only be worth $264,420.60. So what would we see on the statement of financial position? If we're looking here on the statement of financial position at December 31st, oops, wrong color. December 31st, 2016, on the statement of financial position, we would see under liabilities and under non-current liabilities, we would see the bond, payable of $264,420.60. If we were also looking at the income statement, what would we see? Well, under operating expenses, we would see interest expense. And our interest expense would not be the $10,000 we actually paid. How much would it be? The interest expense would not be the $10,000 we paid. How much would it be? $5,380.80, and we can see that when we go back to the chart, right? Because this is the interest expense that we're recording. So absolutely, that would be the amount of the interest expense. It would be $5,380.80. All right, everybody clear with that? And we can move on to the next question. Okay, in that case, let's go here. We're now on question number 3. Now, on question number 3, let's write down the information we have. We have January 1st, 2016 is when we issue the bond. It's going to be $150,000 face amount. The coupon rate is going to be 2%. It's a 4-year bond. What is the market rate? The market rate is 4%. So, now, you put the bond out there, $150,000 face value. You know that an equivalent risk investment vehicle in the open market is going to pay 4%, and your bond that you're issuing is only going to be paid 2%. Are you going to be able to sell it for $150,000? Yes or no? Are you going? Yes, that's exactly. You're going to sell it at a discount. Nobody's going to pay $150,000 when they could go into the market and make an equivalent investment vehicle at the same level of risk is going to pay 4% and your bond is only paying 2%? No way. So what's going to happen is investors won't bid on it at all, and you're going to have to continue to drop the price until the yield on your bond is 4%. So how can we determine the present value? How can we determine the selling price of this bond? We can calculate the present value. So we're going to calculate the present value. Present value of the face amount. So that's $150,000. We need to multiply it times the factor. Can you tell me what you think the factor will be? I'm going to go to the present value tables. This is the present value of $1. What factor should I use? Now, n is equal to 8. This is, just one minute, let me see. Interest is paid on June 30th and December 31st every year. Yes, the n is equal to 8. So we're down here at the 8. Absolutely. What's the factor? The factor is 8548. What? Where did you, 8548? 8548? What's the factor going to be? We are absolutely looking at the market rate. Whoops, somebody's moving my table. I don't know how that's even possible. Don't touch the table. Come on. No problem, Jessica. Which factor? We know that n is equal to 8. I'm just going to circle it again. Now I want to know the factor. So we have 73069, which is at 4%. Oh, guys, I caught you. All right. So no, that's not going to be a factor because the market is equal to 4% for an annual payment. Are they getting an annual payment? Semi-annual. So the rate we want is the market rate divided by the number of payments per year. So previously, remember, the market rate was 2%, and we divided by the number of payments, which is equal to 1. So that's still equal to 2%. But now the market rate is 4%, and the number of payments per year is 2. So that is going to be equal to 2%. So the N periods are the number of periods over the life of the bond, right? 4 years times 2 payments a year is 8. The interest rate, the market rate, is always the market rate divided by the number of payments per year. So now knowing that, what's the factor? $85349. Absolutely. We're going to go down from the 2. So that is 85349 is the factor. So going back over here, we're going to multiply this times 0.89349. What is that going to be equal to? That is going to be equal to 110123 times 0.89349 is equal to $134,023.50. Excellent. Are we finished with the present value? Is that our present value? Is that what we're going to record the bond at? Oh, are you kidding me? Oh my goodness. Just a minute. 85349. Seriously, Alf, 85349. Let me do that. 1 times 0.85349 is equal to 128,023.50. Okay. Thank you very much, Jessica. All right, so is this our present value? Are we going to do a debit to cash and a credit to bond payable for this amount? Yes or no? What are your thoughts? I need an answer. Is this the present value, and can we do the entry? Debit to cash, credit to bond payable. It's not the interest expense. We need the present value of all cash flows. This is the cash flow at the end of the 4 years, $150,000. But what we've neglected to take into account is the cash flow from the interest payments. So it's not interest expense, it's interest payments. Remember, the expense is calculated differently. So we need the present value of the interest payments. We have $150,000 times the coupon rate. What is the coupon rate? We said it was 2%, right? What else do we have to do to this interest rate? because of the number of payments per year. Can we just multiply it times 2%? Because remember, when we were doing the interest rate on the present value table, what did we do to the interest rate? Exactly. It needs to be multiplied by 6/12, which is 1/2. So it needs to be multiplied because it's semi-annually. So how much interest are they going to get every 6 months? $1,500. I'm now going to multiply this times a factor. In order to get the factor from the present value table, I'm going to go to the present value table for the annuity. What is my N? What's my N? 8. What's my interest rate? 2%. Because I'm going to take the market rate, which is 4%, and I'm going to multiply it times the 6/12, or I'm going to take the 4% and I'm going to divide it by the number of payments per year, and that in both cases is 2%. Doesn't matter which one I do, it's still 2%. So I'm going to go to the 2% over to the 8, and my factor is going to be, and this time I'm going to write it down and not be stupid about it, 7.32548. What do you mean 1? Why have I got 1? Do you think it's going to be 1%? I just want to, okay, good. Okay, excellent. So now we know what we're doing, right? This is the page I'm looking for. Nope, this is not the page I'm looking for. This is the page I'm looking for. Yes. Multiplied times the 7.32548 is equal to, times 1500 is equal to 10,988.22. So add these two together, plus 128,023.50 is equal to 139,011.72. So even though the face value, this is the present value, even though the face value of the bond is $150,000, no one would pay $150,000 for it. The most that anybody would pay would be $139,011.72. Does everybody understand why we would pay less for it? Okay. Everybody appears to understand exactly what's going on. So now, what are we going to do? We're going to do the entry for the sale of this bond. So at January 1st, 2016, we're going to do a debit to cash because we're going to receive $139,011.72 from our investors, and we're going to credit the bonds payable for $139,011.72. Now you got to think that the bond payable is going to be at $139,011.72. In 4 years' time, how much money do we have to fork over to the investors? $150,000. So what we're going to have to do is over the next 4 years, we're going to have to do 4 entries that will bring the value up to $150,000. So let's do the chart that will show us what's happening here. So we've got the date here. We've got the cash here. We have the implicit interest right here. We have the difference right here. And we have the present value of the bond right over there. At January 1st, 2016, all of these things are nothing, but the present value of the bond is $139,011.72. Now, let's go back over here to the present value calculation. the fact is, when you look at this difference, minus 150, 1, 2, 3, over the life of the bond, how much are we going to pay them? Well, we're going to pay them $3,000 every single year times 4, right? Because we're going to pay them $1,500, another $1,500. Going to do that twice a year. So we're going to pay them $3,000 times 4, and that is equal to, when you multiply it out, because I'm being incredibly dumb today, $12,000. But we're also going to have to pay the shortfall of $10,988.28. So in the end, we're actually going to pay more than the actual interest, right? Because we have to make up the shortfall, we're going to pay $22,988.28. That's the total amount of interest that we're going to pay now because we accepted less than $150,000 at the beginning of the life of the bond. I said that very rapidly. Does everybody understand what I just said? Thumbs up if we understand the concept. Thank you, Jing Jing. Okay, one more time. Okay, so the actual money that we're going to fork over is we're going to fork over $3,000 annually, $1,500 at June and $1,500 at the end of December. Over the 4 years, we'll fork over $12,000. But we're also going to have to pay the $10,988.28 shortfall because investors only gave us $139, but we're going to pay them $150. So therefore, over the life of the bond, in essence, we are paying them $22,988.28 because we accepted less for the bond at the beginning of its life. And we have to make up the shortfall. Remember last time the investors paid us extra and it made us pay less interest? Well, now the investors paid us less, so we're going to pay more interest. The yield on this bond will be equal to 4%. The $22,988.28 is equivalent to having a 4% bond. Did that help, Joanna? All right. So that's going to be reflected in our calculations. Oops, not this one, in our chart. Okay, so at June 30th, 2016, how much cash are we going to pay them? We're going to pay them $1,500, but we're going to pay implicit interest. We're going to, and don't forget, this is the face times the coupon rate, right? So the face amount times the coupon rate, and then of course divided by 2 because we're doing 2 semi-annual payments. But the implicit interest is going to be $139,011.22 multiplied times the market. So this is the present value times the market, and then adjusted for the number of payments. The market is 4% multiplied times 6 over 12. So that's the implicit interest. Wait for it. I'm going to calculate it. 011.22 times. Jing Jing, why did you get 72? Oh, 72. My apologies. 139,011.72 times 0.04 times 6 divided by 12 is equal to 2780.23. So notice this amount is higher than the cash we're paying. Well, that makes sense because we have to make up the shortfall. So if we now take the $1,500 and subtract the $2,780.23, that means we are paying an extra $1,280.23. We're not paying it right now. We're still only paying the $1,500, but in effect, we're increasing the present value. So we're going to add this in here. 139,011.72 is equal to 140,291.95. Okay, thumbs up if you understand what I just did and why. Thank you, Joanna. Okay, Jingjing, Suhara. Okay, so we seem to be getting a clear understanding of this. Let's do the entry, right? Because we have to do, wait, I'm just going to note down these amounts for a second because they're not in my head. So this is 150. I just don't want to make a mistake with the amounts. 2780.23 and 2780, and then 1280.23. Okay, so now entry at June 30th, 2016. We're going to do a credit to cash for the $1,500 that we're actually going to pay the investors. We're going to do a debit to the interest expense of 2780.23, and we're going to do a credit to the bond payable. So remember, we're increasing the value of the bond payable by 1280.23. If we now jump back to where we were before, oops, not this one. Nope, I seem to be jumping around my, here it is. We're going to do 1280.23. So we're increasing the value of the bond payable. If we looked at the statement of financial position right now at June 30th, what would it look like? Well, the statement of financial position, the statement of financial position would show this amount right here under bonds payable, long-term liabilities. The interest expense that would show up on the income statement would be the $2,780.23. How is our level of understanding on what's going on? Thumbs up if you've got it. Okay, so now let's look at December 31st, 2016. What are we going to pay? We're still going to pay $1,500. What is the implicit interest that we're paying? Well, it's going to be the $140,291.95 multiplied times the 4% multiplied times the 6/12 because it's only 6 months of interest. What is this equal to? Wait for it. I'm calculating it. Times 0.02. I got 2805.84. Did everybody else get that too? Okay, good. Thank you, Joanna. All right, so now I'm going to take the $2,805.84. I'm going to subtract the $1,500 to get the difference, which is $1,305.84. So again, I'm going to add it in here, and that's going to increase my present value. So that's plus 140,291.95. What is that equal to? 141,597.79. Questions, or are we all kind of getting it? Okay, we got thumbs up. Excellent. Just one second. I'm going to do the entry. Okay, so what entry are we actually going to do? Well, we're going to do the entry at December 31st. We're going to do a credit to the cash for the $1,500. We're going to do the debit to the interest expense, which is the higher amount of 2805.84. And then we're going to credit the bond payable by the 1305.84. If we then look, ooh, I keep going to the wrong thing. Yes. Over here, we're going to add 1305.84. Now, I said there would be 4 entries. There's actually going to be 8 entries, right? I'm sorry, I can't do 8 entries here, but you know there's going to be 8 entries because we have to do an entry every half year. So there's actually going to be 8 entries. We're going to do one every 6 months. Okay. On the chart, we could just keep going, right? We could do an entry for June 30th, 2017, and then an entry for December 31st, 2017. We would do an entry for June 30th, 2018, December 31st, 2018, then we do 2019, and by the end of December 31st, 2019, the amount over here at December 31st, 2019 should be what? Yes, exactly. All right, guys, that is the end of bonds payable. If you have any difficulty with this concept, one, I suggest you watch this whole webinar again, but two, you can also post to the discussion board. I do find the use of this chart incredibly important, and I mean, the semi-annual, I would never make you do the whole chart if it was semi-annual because it's too much work. But I could probably ask you for the first year, so the first 2 entries or the first 4 entries for the first 2 years. I would never give you a chart that's asking for monthly because that would be insane. And if you can do it for the first period, you can do it for all the other periods also. Remember what the difference is when we sell it for a discount, we're adding in this value every single time. Whereas when we sold it at a premium, just a second, I have to find where we sold it for a premium. Where's my chart? When we sold it for a premium, don't forget we're subtracting it. And we're ending up with the face value at the end of it. That's exactly what would happen way over here too. We would end up with the $150,000. All right. I hope this was very, very helpful for your learning and that you've got a much clearer idea of how to deal with bond payable. Keep in mind that if you're moving forward to intermediate financial accounting, this is an incredibly important concept. So at the last year of entry would be, at the last year, the entry would be very similar to what we did before, right? We would still, wait one second. At the last year, the entry would be similar to this, right? And then our last entry at December 31st would of course be the debit to the bond payable. And this of course would be in the very last year, 2019 December, it would be $150,000. And credit of cash, $150,000. But we would first have to do a similar entry to what you saw there. Yes, exactly. That's what you would see. No problem. You are very, very welcome. You have a great night too, guys. Take care of yourselves. And thank you again so much for joining me. I really appreciate it.